Welcome back to Trades and Gains, everyone. Earnings season is here. And you know what that means. Financial Twitter is going to give you a bunch of false data and skewed perceptions. Analysts are upgrading stocks they already missed. And retail is about to learn, again, that earnings isn't about the number. It's about positioning. And it's also about their balance sheet and what they're talking about. Today, we're going to go ahead and break down two earnings reports that everyone's watching this week. Netflix and Intel. These, by the way, two completely different stories. Nothing to do with each other. Very different. So get that through your head, okay? One is a media monopoly with ad ambitions. The other is a legacy chip maker fighting for relevance in an AI world. But instead of trading vibes or headlines, we're asking one question. What are dealers actually positioned for going into earnings? Because dealers don't guess, they hedge risk, okay? And that's the main thing you need to understand. And when you follow their hedges, you see where the landmines may lie. And we're gonna find all of this, by the way, using Investor Central Club, where we give you alpha, we give you all that before the market catches on to it. Yes, some of the plays may be front ran. Yes, we may be early, but we are hardly wrong. So quick framework before we dive in. Okay, we filtered Investor Central Club for size, repetition, block versus sweep behavior, expiration proximity, and call versus put imbalance. What we're not gonna do today, honey, what we ain't finna do here, okay? One-off lotto trades, random retail YOLOs that you find on Twitter, FinTwit, or CNBC guest opinions. Because guess what? I don't care. I don't care who you are. I want the numbers. I want the data, okay? We're gonna go ahead and track where risk is accumulating, because earnings isn't about who's right, it's about who's currently offsides. So let's go ahead, kick this show off, and talk about one of the most controversial streaming companies out right now, in my opinion, Netflix. Now, the headline narrative: Netflix is going to report Q4 earnings with EPS expected around 55 cents, revenue near 11.97 billion, and growth driven by international subscribers, advertising revenue, and price increases. But I'm not talking about your mother. There's an elephant in the room. The Warner Brothers Discovery acquisition drama. We're looking at legal challenges, competing bids, and regulatory risk. This should be a volatility bomb, but the options market went ahead and said, whoa, 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 there. Whoa there, buddy. Not so fast. So we saw 27.21 million in total overall flow between January 5th to January 16th, our last trading day. Okay? 22 million came into that for calls. 4 million came in for puts. We're seeing repeated positioning. Granted, our biggest one, which if you do follow Free Wi-Fi Radio, we hopped into this, are these sexy little $110 calls due for August 21st of 2026, okay? That was a volume play that I took. 22,000 contracts, far timeout. Yeah, give me that time. Give me that time, honey. Now, in terms of the shorter term plays we're seeing here, we see $88 at 123. Like what? This is 470, 900, 500, 1.5, 2 million, 2.4. Like, you get the gist. You get the gist here, okay? And that's not only for 88. We're also seeing that at 90, 95, so on and so forth, okay? A lot of upside targets here. Shoot, even one of the biggest put buys were for $90 calls due for 2027, folks. And again, we're looking at multiple leg block trades Very limited aggressive put buying. If anything, it's buying the support that it's building right now. And this is important because when dealers expect chaos, they buy protection, they jack up puts, and they widen the volatility. That's not happening here. This is what dealers are actually signaling. This flow says dealers are comfortable. Downside is not the base case they're looking at, and earnings volatility is expected to be contained. Even with the Warner Brother deal uncertainty, well, why? Well, guess what? Because subscriber growth is still steady, ads are still scaling out, and Netflix controls pricing power better than their peers. This isn't a YOLO growth stock anymore. It's a cash flow machine with optionality. Now, how does the news fit the flow exactly? Well, analysts are split publicly. Some worry about the WBD deal dragging EPS. Others see international plus ads as the real story. But notice something here, okay? Estimates have been revised up more than down, okay? And that's always a good sign going into earnings. If you see estimates continuing being pushed up, that is a key and a signal that, well, there's some good news headed their way. And another thing, I'm pretty sure Trump bought like $1 million and something that had to do with Netflix. I posted about it yesterday if you read that. Now, this completely lines up with the flow. Dealers aren't hedging for a disaster here. They're hedging expectation drift. Now, here are our earnings scenarios, okay? For the bull case, add surprise to the upside. International growth offsets US softness. The stock holds above $88 and dealers remain long gamma, which means volatility is just going to collapse. The chop case, which is most likely in here, I think, earnings are fine, guidance is cautious, stock pins near heavy call open interest, and premium sellers feast. In the bear case, Warner Brothers, the drama just escalates like a Real Housewives episode, or when you found out that Mormon girl liked to pee in her husband's fruity pebbles. Guidance disappoints, but downside is not structurally reinforced in this case, meaning dips are likely bought up quickly. The Netflix takeaway here, dealers are positioned for control, not chaos, okay? Now, the next one we're going to talk about is Intel. The incel of the AI chip world right now. The ugly sister that no one wants to acknowledge because she hasn't gotten hot yet. And who can blame them, you know? I wouldn't look two ways. This is where the tone shifts, though. The story everyone knows. Intel reports Q4 earnings with EPS expected around 8 cents, revenue near 13.37 billion. The bull thesis, data center and AI growth, foundry services progress, CHIPS Act funding, and quote-unquote new Intel narrative. The stock is up over 100% year over year, and that matters because expectations are no longer low. There's no more, this is like the redheaded stepchild that you need to bail out of jail every other month, okay? Now, the Intel call options flow is very different behavior, and here's what the flow is telling us. We're seeing 24.6 million in total premiums. And from, again, January 5th of 2026 to January 16th of 2026. Now, we saw 17 million of that go into calls, with 7 million going into puts. Some of our biggest blocks are at the $45 put. We saw 2.7 million dropped on this. Again, this was kind of in the money. This was on 1.9. Who knows if they're still in it? The volume was at 7,000. Open interest, not that high. We also saw 48 as another pinpoint. 48's coming through here. We saw 50s coming through as well as a pinpoint, with some more $50 ranges as well. Longer dated puts mixed with, well, those short-term calls. We can see 220, 115, 717, 320. So it looks like everyone's trying to gear up for this 320 2026 for these call options that we're seeing on Intel. This is not confidence. This is what we like to call uncertainty management, because Intel is like that redheaded stepchild. You just don't know what kind of mood they're going to wake up in today. Now, what are dealers doing here? Intel Flow says dealers expect a headline beat, but they're protecting against guidance risk. This is classic good quarter, but a messy outlook, which makes sense. Intel is spending super aggressively, competing with NVIDIA on AI, while NVIDIA is also like testing their chips for them. Like, what? Again, it's all one big circle jerk. It's just a big circle jerk, okay? Navigating geopolitics as well, which I don't think they do very well in the first place, so I don't trust that. And they're managing a massive capex for a business that has lost them almost $11 billion in the last year. Their foundry is their Achilles heel. It is make him go left in basketball terms. They can't go left, so make them dribble left. That's the foundry business for Intel. And guess what? That's not clean. That's like when you wake up, pull your underwear down, and you see skid marks in it. Now, this is how the news matches the flow. Public commentary says data center and AI up about 30%. Client computing stabilizing, and foundry is still unproven. Because why? They still have no customers for their foundry business. Seems kind of like a problem. Now, if we looked at Zacks, it's showing positive earnings EPS, but declining long-term margin confidence. That explains the flow perfectly. Dealers are currently saying, we'll trade the beat, but we're not marrying this thing because it's my cousin. Intel call earnings scenarios, the bull case. EPS beats cleanly, data center and AI accelerates, foundry narrative gains credibility by announcing they have a customer finally, and the stock clears $50, which has been the new psychological level. I told everyone in our Investor Central Club Discord that 44 was the key institutional level to go to 50, and guess what happened? Exactly that. And dealers chase upside hedges. Now, the chop case, which is the most likely scenario. We see a beat on EPS, conservative 2026 guidance. Stock stalls. IV crush wrecks both sides. I can see that. And I think that's why we're seeing a lot of March 20th thrown out there. You know, gives a little bit of time to recover. Marinate. You know what I mean? Because if you don't let your meat marinate, it's going to come out dry. Now, the bear case. CapEx, it's going to spook investors. Margins, they disappoint, you know, like Intel does. Guidance resets expectations. That might happen. And the stock retraces toward dealer hedging zones. The main takeaway here, this is a volatility plus narrative trade, not a directional slam dunk, unfortunately. So let's talk about Netflix versus Intel scorecard. All right. For Netflix, the dealer bias, we're looking at controlled bullish. The volatility is on the lower end, and the risk is much cleaner. Intel call is hedged and cautious. They're definitely wearing 2 condoms, and they made that girl wear a, what do they call it? A dental dam. It's hedged and cautious, all right? Volatility is way higher, and the risk is just, it's messy. It's like when you catch your stepbrother sleeping with your mom. If you're trading earnings, Netflix favors price structure and just structure overall. Intel, it favors patience or spreads or longer dated, right? Like, we're not seeing anything on the weekly really for this on Intel. Let's get real here. Let's get real here. We're looking at March 20th, 2026. Now, why does this matter exactly? Why should you care? Well, this is why we follow flow. Headlines tell stories. Dealers manage the risk. Netflix, it shows confidence, stability, and controlled expectations. Intel shows, well, hope, protection, and fragile optimism because, well, most people who invest in Intel have fragile egos, so it makes sense. And earnings, well, they don't reward optimism. They want actual facts. That's why it's called earnings and not hopium. It rewards positioning, discipline. So listen, we've had some fun. We've gotten to know each other. We've really become one. Okay. If you want real-time options flow, dealer positioning, earnings set up before the move,
Join Investor Central Club. All right. Use Stacks Apex, Stacks Apex, that's STAX Apex, for 20% off your first month. I'll put the link down in the description below. We also have some other cool tools. The reason I said Apex, speaking of that, look at that. Would you look at that? We got Gamma, DDOI. We got it all here, baby. And guess what? Unlike Heat Seeker, you don't have to pay $250 a week for it. This comes with the options flow data. So you don't need like 5 different tools like Unusual Whales, Tradedics, Heat Seeker, all these other like tools. You just need to pay $100 a month. You get all this, and I got more stuff cooking because we even got a stacks tracker, baby. This was my baby. I made an MVP for this. Chef cooked it up in the kitchen. That's why we call him Chef. The next thing we're going to be opening up, hopefully, if I get approval for it, is an open interest reporter. So every morning, open interest will reset, and you'll be one of the first people to know about it. And we'll have filtering, and the smart filtering, that is our proprietary software, to actually make it readable and give you guys like real winners versus like losing trades like you see in all those other discords you're a part of. Anyways, this is Stacks Tracker. This also comes with a subscription. God, we're like Amazon basically, except we give like better products, and nobody's out here drop shipping our data for free. Anyways, I'm Max Pitts. This has been Trades and Gains. Make sure you like, subscribe, comment. Tell me, should I buy Intel calls or Netflix calls going into this week? I will buy them. Market open on Tuesday. I'll see you guys tomorrow. I'm going to do a Degenomics course tonight, so make sure you show up to that at Free Wi-Fi Radio. Love you guys. Have a great rest of your day, and happy Sunday. Mwah.